I'd like to do today is to try to give you my outlook for the global economy. So I'm going to start today talking about the things that are going well in the global economy, and of course, then I'm going to move and talk about the downside risks. I think there are at least 4 developments in the global economy that are positive that we have to recognize. The first one is actually not just a cyclical factor, but is long-term and secular. That is the rise of the economic, trading, and financial powers of emerging market economies. Emerging market economies have much higher potential growth rate than advanced economies, 4 to 8%, while in advanced economies, potential growth is only 1.5 to, at best, 3%. And therefore, for the next decades, a greater share of global GDP and global growth is going to be accounted by emerging markets. The second positive about the global economy is that there is at least one sector of the economy that is doing well. We know that in many economies, households are damaged. In the US, in Europe, in advanced economies, there's too much debt and leverage. Households have to retrench. We know that state and local government and central government in advanced economies have too much deficits and debt. We know that still a number of banks and financial institutions in advanced economies from US to Europe are still damaged and they are deleveraging. But if there is one sector of the economy is doing well, is the corporate sector, especially high-grade corporates in the US, in Europe, in Japan, in other advanced economies, and also in most emerging market economies. These high-grade corporations have become much more productive, much more efficient, have been slashing costs during the crisis. Of course, that has been painful in terms of job losses and rise in unemployment rate, but right now they're highly productive. Earnings and profits have been surprising on the upside quarter after quarter, and if this corporate becomes more confident about the global economic recovery, a recovery that started after the last financial crisis in the summer of 2009. The third trend that is important in the global economy is positive, is this trend towards globalization. In spite of the recent economic and financial crisis, the most severe we had in 60 years, the process of globalization has not been reversed. There is still greater trade in goods. There is now greater trade in services as information technologies allow now also non-traded goods, services to be traded. There is more movement of capital. There is more movement of labor. There is more movement of information, of technology, and the other things that make and increase productivity. Over time, if we can manage globalization well, that greater integration of the global economy can be beneficial for most people, if not all people, and even those who can lose from it can be compensated. Therefore, that's a powerful force. No country is anymore an island. We're an integrated global economy with greater flows of goods, services, capital, labor, information, technology, and that in the long run is beneficial. There'll be a slowdown of growth in emerging markets, but these emerging markets, while they're going to slow down, they're not going to experience a recession, even if there is a recession in advanced economies, for 3 reasons. 1, their potential growth is much higher. 2, their balance sheets in terms of debt and leverage are in much better shape, both in the private and the public sector. And 3, these emerging market economies have more policy bullets to react to an economic slowdown and try to counter this economic downturn with monetary, fiscal, and other types of stimulus. Whether you call this one a double-dip recession, or whether you call it continuation of the first recession, or whether you're going to call it a second recession, it doesn't matter. It's just semantic. There's a risk of an economic downturn. And today I would assign at least a 2/3 probability that there is going to be this economic downturn in US, in most of Europe, and in other advanced economies. The first observation I'll make is the following one. The economic recovery after the last economic and financial crisis in most advanced economies was anemic, subpar, below trend, was more like a U-shaped recovery rather than a typical V-shaped recovery that you have after a plain vanilla recession. And the reason why the recovery was anemic was that this was not a typical recession, was a recession caused by financial crisis, and a financial crisis caused by too much debt and leverage, first in the private sector, households, banks, financial institutions, even a fat tail of the corporate sector. And as a reaction to the crisis, fiscal stimulus and socialization of the private losses, now we have not only private debt and deficit, but also public debt and deficit that have been rising very sharply in most advanced economies. Budget deficits of 10% of GDP, public debt expected by IMF to reach an average of 100% of GDP in advanced economies by next year. And whenever you have too much debt and leverage out of a recession, a financial crisis, there is slow economic growth for a number of years because there is a painful process of deleveraging. You have to spend less in the private and public sector to save more or de-save less in order to reduce over time debts and deficits that are excessive. And that slowdown in the spending is the reason why the recovery is anemic, subpar, below trend. And the constraint to higher economic growth in South Africa are structural. You need to invest into more capital, more infrastructure capital. You might have plenty of resources in the ground, but unless you have the infrastructure to take them out of the ground, move them to the ports and ship them, you're not going to be able to fully exploit even your mineral resources. There's a huge amount of need for investment in human capital. As we know, the skills of the students, of the labor force are not sufficient. In the long run, productivity growth depends on human capital and giving skills, education, training, and making sure that these workers can compete in the country and the global economy. You have to invest into physical capital, more capital spending, so infrastructure, human capital, physical capital. Those are the kind of things that are needed, can be done, but have to be done and accelerated to make sure that potential growth increases, that the country grows robustly, and the social tensions that derive from poverty, unemployment, and inequality are going to be slowly dampened over time. Those are the policy challenges the country is facing. Commodity prices have already corrected from the peaks of earlier this year as people are already starting to price in slower economic growth in advanced economies and also emerging markets. And while emerging markets are still growing robustly, the lack or the fall in demand coming from advanced economies is going to weaken that demand for commodities. And once, through trade and financial transmission effects, the slowdown and the contraction of advanced economies is going to lead to some slowdown of growth, even in China and other emerging markets, even their own demand for commodities is going to be slower. And for any given supply, lower demand is going to imply lower prices. Some of it is already priced in, but the markets are not yet pricing in my view, a recession in advanced economies. So if that recession were to materialize, there is more downside risk for commodities. Now, last year when there was a risk of a US recession, quantitative easing by the US led to a wall of liquidity chasing assets, and the assets that went up in price were commodities and emerging market assets. And some people believe that another round of quantitative easing by the Fed is going to lead to the same effect. I'm not sure that this time around that effect is going to occur for two reasons. First of all, while the Fed is going to ease, Europe is going to ease too, the UK, Japan, the Swiss. And if everybody is going to ease monetary policy, the dollar is not going to weaken as much as last year when the Fed was easing and everybody else was on hold or tightening. So if the dollar is not going to fall, the relation between a weaker dollar and a rise in the dollar price of commodity is not going to occur this time around.